The pandemic and the Ukraine-Russia conflict significantly upended the supply chain ecosystems, which had become too used to globalization, causing supply chain bottlenecks to result in global inflation. At first, every central bank ignored it, considering it to transient in nature. However, as the external factors remained persistent, central bankers began to realize that the inflation is here to stay and needs to be controlled. This is what kickstarted rate hikes globally amongst various central bankers. Rate hikes by the Federal Reserve, Bank of England, European Union, and the Reserve Bank of India, to name a few central banking regulators, have been notable and substantial. Rate hikes usually reduce the aggregate demand in the economy, thereby cooling the overheating in the economy. Private markets, even though not marked to market, experience large unrealized losses on account of higher discount rates. Thus, rate hikes largely result in decline in the value of financial assets. Real assets become more valuable as they serve as a good hedge against inflation. This is where gold as an asset class comes in. Building the case for gold ETF as an asset class. Since gold serves as an effective inflation hedge, investing in gold in times of high inflation and high interest rates is an effective investment strategy. ETFs, exchange-traded funds, are an effective way to gain exposure to the asset class without having to physically buy gold, though must add a rider here that in the southern part of India, buying physical gold still takes a lot of precedence over gold ETFs. ETFs offer the much-needed advantage of a real asset class exposure with the feature of liquidity that makes financial assets attractive. While the amount of investment in gold ETFs and the timing are a function of where an investor is in their portfolio journey, it is a good asset class to evaluate during times of uncertainty such as today. As the world moves to regionalization from globalization and nearshoring from offshoring, efficiency will not be the topmost parameter of consideration, and thus inflation is expected to remain elevated, though not to its current levels. With this background in mind, it would be feasible to evaluate gold ETFs as an asset class to consider in the portfolio allocation strategy, of course subject to the overall return and risk objectives of the investor. While we live in a high interest rate environment today, the reality may change in the next 18 months, and hence it's imperative that every investor have in place an effective portfolio rebalancing strategy that would time the macroeconomic expectations in line with the investor-specific risk and return objectives.